Market impact of the coronavirus has been severe. The global stock market is down between 20 to 30% for the year now, and the US is officially in a bear market. Right now, the psychology of the markets is like a weighing scale. On one hand, investors are fearful about the world, and on the other, we have the measures taken by authorities to manage the crisis. The question is, which one will tip the balance? At the moment, unfortunately, fear is winning, simply because the implications of new developments are just not clear, and the instinctive reaction is to sell. We encourage you, please, to take a breath and not panic. One of the worst things to do now is sell everything, especially if you have already suffered large losses. It's extremely difficult to predict the bottom of the market, and it can be harmful to your portfolio if you miss the large rebounds that you typically see after a sell-off. In fact, we actually like equities still for the long term, and valuations are now even more attractive than they were before. But we do expect volatility to persist and markets to keep seesawing. Hence, we have made some changes to our investment views over the next 3 months. We have downgraded global equities from overweight to neutral. We still think equities are an attractive investment over the long term, but for now, caution is warranted. I stress this is a modest reduction and not a call to sell everything. We are upgrading investment-grade corporate bonds from underweight to neutral. Corporate bonds are now cheaper and more attractive after the sell-off. They are also more defensive compared to equities and are useful portfolio diversifiers. Investors should optimize their portfolios. High-quality bonds should be included, even though these bonds, particularly those issued by the US and other governments, are now even more expensive than before. Despite this, they are still worth including as a form of insurance against volatility. But there are other ways to diversify. You could also consider alternative investment strategies that aim to achieve returns regardless of market conditions. Alternatively, just keep it simple. A traditional multi-asset portfolio where risk management is handled by professionals is a sound investment. With uncertainty comes Asian authorities have taken aggressive monetary and fiscal action to combat economic weakness, and lower oil prices are actually a good thing for them. Asia also had to confront the coronavirus outbreak before the rest of the world, and is arguably closer to returning to some semblance of normality now. This can only be a boon to their economy, and it would be positive for emerging markets and Asian investments. Please stay safe wherever you are.